Hello, everyone. Thanks for joining us. I'm delighted to welcome you all in today's PSDRN webinar. And for those new here, PSDRN is a research network consisting of development finance institutions, think tanks, and academic institutions, all of which actively support research on private sector development. More information on this will follow in the chat box. Keep an eye on that. Today's seminar is hosted by International Growth Center, IGC for short, which is one of the founding members of PSTRN. The IGC is a research institution based within London School of Economics. It does two main things. It funds rigorous economic research that is relevant to low-income countries and translate the findings from those research projects into actionable policies led by 10 country teams spread across Africa, South Asia, and the Middle East. The paper you're going to hear about today is a prime example of IGC's work, partially funded by our SGB Evidence Fund. And you can find out more about IGC and SGB Evidence Fund on our website, also posted in the chat box. My name is Rahul Shukla. I'm a research coordinator in the firm's trade and productivity team at IGC. And I will be moderating today's exciting discussion on large-scale survey about Africa's startup ecosystem. And to deliver this, let me introduce today's speaker, Emanuele Colonelli, who is Professor of Finance and Entrepreneurship at University of Chicago Booth School of Business. He serves as co-chair of the finance sector at JPAL and leads the finance and entrepreneurship team at PIDL. His research sits at the intersection of finance, development, and political economy with a focus on high-growth entrepreneurship and firm-state investor dynamics. In this session, Emanuele will present findings from a large-scale study on Africa's high-growth startup ecosystem, co-authored with his colleagues at the IFC and Stanford. Drawing from novel data sets and surveys across 47 countries, the study explores how African startups are financed, the implications of this financing structure, and the challenges in building a local startup ecosystem. So before I pass the word to Emanuele, let me get a couple logistical points out of the way. The presentation will last around 40 minutes, after which we'll have about 15 minutes for Q&A. If you have any questions, and I encourage you to ask away because we want this session to be interactive, please put your questions in the Q&A box at the bottom of your screen. When you do so, please include your full name and organization as well. Lastly, today's session is being recorded. Both video and audio recordings will be made available on the IGC and PSDRN websites after the session. That is all from my side. Emanuele, it's a pleasure to have you here today. The floor is yours. Thank you.
Thank you, Rahul, for the very kind introduction. I'm going to start by sharing the slides as well, so you let me know if you see them.
Yeah.
They're all good, right? Perfect.
Yeah.
Okay, such a pleasure to be here, and great to see so many familiar names in the list of people around. So hopefully we'll have a fun hour together. Let me start by doing two thanks, though. One is to the IGC, because for those of you who know less about it, it's been one of the, if not one of the only, but one of the main, certainly, organizations that helped a generation of researchers like me early on during the early stages of the PhD and later to start doing work on private sector development in many low-income countries. And I think, especially in today's times, this is something that is very unique. It's been very much appreciated. And I think the field of development that has now created a big component on private sector, I think owes a lot to the IGC. And so I'm definitely very grateful. And the other thanks to the IFC. I know we have some of my colleagues, both as co-authors on the paper and on the call, but we need organizations like the IFC to help us do this kind of like big research. IFC, for those of you, of course, I think all of you know that like it's obviously like the biggest, to some extent, emerging market investor around the world. And so recently they started a number of projects. I'm lucky to be part of some of them, but in general, I wanted to say thanks because a lot of these studies are going to need a lot of participation from both us academics as well as sort of like more important real world players. And the IFC moving towards the research side has been a big piece of news for us doing work on development. So let me get started. And let me also say, like, this is joint work with also like Tommaso from Colombia, Chun is a PhD student, and Marcio Mariana from the IFC. It's still all sort of like part of a bigger project in which we try to shed light on what I think is still a very understudied, yet very important topic, I think, broadly in development, which is that of high growth entrepreneurship, high growth capital, such as venture capital, private equity flows in this context. And so this is one of the first studies we're working on, more to come. At the same time, it's also a study that is broad and quite preliminary in nature to some extent, which means that to some extent, it's going to be benefiting a lot from many comments from especially practitioners. So this presentation will have lots of like facts for which we would love input on how to interpret and how to think about it. And of course, it's going to be also having like some more boring economic details as to how we think about why we need surveys, experiments, and ways of looking at the data that are a bit more complex than just going through the basic facts. And so apologies if parts of them sound a bit dry to you. But let me get started, and I'll overrule Raul to some extent, in the sense that like if you have any questions, you should feel free to just ask. I may not be able to see the chat, but I think Raul will be able to ask questions, or I'm happy for people to, if needed, sort of like unmute themselves and ask the question that way. And then if questions are more complex, I can take them for later. Okay, so motivation is somewhat easy, I think, for this paper, which is there has been a very thriving startup scene in a lot of the African continent. If you look at 2022, which to some extent has been a peak, we saw about $7 billion raised by startups, which I will define shortly. And this represents massive growth, given that this was a context where, if you go back a decade or so, you saw a lot less activity, near zero to some extent, according to the US standards, for instance. Other examples for motivating this, Y Combinator is the biggest, or at least the most famous incubator of startups around the world. In 2022, nearly half of the startups were actually from, compared to like Europe, were from Africa as well. We have several examples of unicorns, companies worth 1 billion or more that were born out of Africa. We have example in many different sectors, like Andela for talent, Flutterwave, and Cheaper Cash on fintech, and many other examples I'm not sort of like listing here. The reason why we should care about this, of course, is that, and the reason why we see perhaps like capital flowing, is that there is a lot of impact that could come from this. Startups or like high growth tech-enabled young companies, we know are driver of innovations. They're drivers of innovation in rich economies, then there is no reason to not think that this could be the case, if not larger, also in many low-income countries. Why? They create products that can be transformational. We've had some example of leapfrogging in Africa with the case of mobile payments. And in general, there is a lot of excitement about, in a context where you have so many frictions, maybe technology can help us overcome some of the big frictions and therefore lead to growth that is faster and perhaps exponential. Of course, this is not a sector that we should think of as creating lots of employment. So that's something to keep in mind when we interpret some of the results. Why do we study this? Some of these facts that I'm going to show you, I think, are going to resonate with many of you who know the context. But a lot of what we know is spotty evidence from certain sort of like data providers, but we don't really have much academic evidence on this that allow us, for example, to compare what's happening in Africa to other contexts, to dig deeper a bit into the micro data of who's creating these companies and so on and so forth. And so that's what we're trying to do with this paper. We're going to try to take a first step at bridging, on the one hand, a development literature that has for a long time focused on micro enterprises, for very good reasons, perhaps, but that's a lot of what we know for the development literature. And then we have the entrepreneurship VC finance literature that focuses primarily on high-income countries. Lots of what we do, lots of why we think about like how we think about VC is very much Silicon Valley based and typically sort of like US based for the largest extent. And this is in contrast with a big policy debate that we see among many of the supporters of this type of event, like DFIs, as well as private capital investors, where they are looking at Africa, they are looking at emerging markets. That's where we've seen a lot of the growth. And so we want to understand this context better. Let me give you also one figure as motivation for understanding why this is relevant. So here we are normalizing in 2010 the level of investments from broadly you can think of venture capital. I'll be more precise, but we see that like the number of deals like going to unique startups across Africa has been growing quite a lot from 2010. And in particular, it's been growing even faster than other emerging markets. You can think of India, China, and the like. And of course, it's been growing a lot more compared to like the US, Europe, and other high-income countries. Then we see that like when there was a drop in activity globally after the boom of 2020 to 2022, we saw that Africa perhaps saw the biggest drop in terms of growth rate, which is something I want you to keep in mind when we think about perhaps the drivers of what could be maybe a fragile ecosystem we need to be aware of. But that's something you can keep in mind as we go throughout the paper. So what does the paper do? It does a few things. First, the starting point, like anything where we don't really know much about, it's to create new data. And so we're going to try to rigorously combine various existing as well as new from an academic perspective, of course, data sources that focus on both companies and founders. And so we can understand a bit better what are the determinants that we see of these financial flows, and perhaps we can also understand a bit better the human capital side of this. Who creates these companies? Where do they come from? And why does this matter? The key factor we're going to try to highlight as part of like the more descriptive analysis of this new data is that something that, again, it's going to be anecdotally very resonating, I think, which is the startups in Africa very much rely on foreign capital. And I will be clear on what I mean by foreign capital, but you can think of it as lots of the capital come from foreign investors. And so that's going to be something we're going to be able to benchmark to other contexts as well. And that seems to be very, very striking patterns observed that characterizes this new ecosystem. Then we're going to do two things in this current paper. I'm sure there are many, many more things we can do, and feedback on those margins will be very useful. But in this paper, we're going to do two things. We're going to try to understand a bit more what are the implications of this ecosystem that is dominated by foreign investors. And in particular, what we're going to see is that the foreign capital we see that is dominating the ecosystem is actually potentially something that has implications for the development of this ecosystem. Because we're going to see that there's going to be a lot of human capital that is also foreign. And we're going to try to argue to some extent that there is a link that goes from financial capital that is foreign leads to human capital that is foreign. We're going to see that there is also potentially something about the type of companies being built. You have foreign investors. We're going to see that you're going to have companies that are making products that look more like foreign products rather than local products. Again, lots of the things that we're going to try to clarify soon. And also, we're going to see that like if you rely so much on a context that is very much foreign dominated, of course, foreign shocks you can expect to have an impact on the local ecosystem, which means perhaps you have a more fragile ecosystem that will be affected by negative or positive shocks that have nothing to do perhaps with the performance of the local economies. And so that's also something, again, we want to keep in mind. Then the second part, we're going to look at the drivers. So we understand a bit the implications of this foreign funding of African startups. What are the drivers? Of course, we cannot speak to all of them, but we're going to try to mostly focus on whether we see this dominance of foreign capital being driven by, on the one hand, startups in Africa really wanting foreign investors, because foreign investors perhaps may bring more than just capital. That's the typical argument you have in venture capital and private equity. You want investors who are capital providers perhaps, but also providers of other support type of like services, from mentoring, from coaching, from network, and so on and so forth. Or whether what we see is just the representation of startups in Africa wanting capital that is only available foreign, in foreign contexts. And in particular, we're going to see that this is the dominant explanation, and in particular that it sounds like startups in Africa mostly want equity financing. Equity financing, as we will see, is notoriously lacking in a lot of the African countries we're going to look at. We're going to have very few local fund managers. We're going to have very little sort of like institutional investors that can provide this capital. And so as a result, it's not surprising that we see this dominance of foreign investors and foreign capital, driven by the fact that those are the ones that provide this type of capital for growth and for high growth and risk-bearing capital that is not available locally. And we're going to do this through a survey that we did across almost all the countries in Africa, This is a survey that has been very much supported by the IFC and that I spent quite some time talking about at the end. The key takeaway of this broad analysis, where we have a fact, some implications of this fact, and some understanding of the drivers, will lead us to have one takeaway that I would like you to have, which is there is clearly a missing local equity market in Africa, which might lead to potential distortions that we're going to discuss. That's the implications part. And so if we think about like what we should think about from a development perspective, of course, think about how to develop a local equity market seems to be important, how to develop local investors, and so on and so forth. Because if you rely on the foreign side, you're going to have a few things that you need to think about. But more on this later. Roadmap for today, data, quickly, establishing these key facts from the data, talking about the implications, and moving then to the drivers with the survey. I'm not seeing questions, Raul, but if there are any pending and important questions now, it would be a good time. If not, I'm going to move on.
We don't have any questions as of now, Emmanuel. So.
Perfect. I'll continue for now. Okay. So data, what do we use as part of this paper? We use lots of the usual suspects, but hopefully in a nice sort of like cohesive manner. In particular, we're going to, first of all, try to give you a definition. So there is no real definition of startups, right? If you think about it, the way we're going to think about startups is going to be that if you want to look at where the capital has been going and who are the startups that made it, then one easy, quick definition would be, let's define startups as those that received high growth capital, such as venture capital or growth equity in T. And so for VC, that would be, for those of you who are familiar with the lingo, will be from pre-seed to advanced series of VC capital, from series A to E. That's where we draw the cutoff, and then growth equity. Mostly this is going to capture a lot of the private equity activity in the continent because we have very little LBOs and infrastructure type of like funding compared to other contexts. And we don't think of those as definitely like startups. We think of that as a very, very different ecosystem, but that is not part of this study. And how, once we have this definition, how do we get to create a universe of some sort of like of these deals and these companies over time? We're going to match what is the workers sort of like data sets that people use in VC, which tries to be global. That's going to be PitchBook that many of you are familiar with. That's the typical data sets also like venture capitalists would look at when they try to do some like simple due diligence. And it's going to be very, very good at covering lots of the activity in the US, in Europe, in all markets, including Africa. But of course, you can expect that it's not going to be as representative as you would want. Why? Because, of course, the way the data is collected in this type of data sets is that it relies on partners. Partners are often partners in the same context of a Silicon Valley type of investors, or on regulatory disclosures and news that tend to be easier to capture in rich economies, and certainly in the US. And so what we're going to do to alleviate this issue is that we're going to combine this with data sets that those of you familiar with the VC ecosystem in Africa will know. These are data sets from Brighter Bridges and Africa the Big Deal. These are like, you can think of it in a cheap way as the local PitchBook competitors. In practice, what they do is that they use a lot of the ground presence they have, a lot of the connections to build a similar data sets to PitchBook that is much richer. And in fact, when I say much, notice that if you were only to rely on PitchBook to do this type of analysis, you would miss about half of the deals, typically the early stage deals. And so that's going to be important when we think about making sure we are representative of the entire ecosystem. We do a lot of work to sort of like put them together, but I'm going to skip those boring details. The one other piece of information we add, which I think is also quite novel in combination of this, is that we match all of this, meaning all the companies and all the deals that we see in these the two first bullet points with the universal LinkedIn profiles. LinkedIn will be able to give us characteristics of the founders, the firm employees, as well as like a few other pieces of information about what the company does. And this is nice because LinkedIn, as a source of data, I think it's going to be significantly more utilized going forward. If I had to do a study on, I don't know, government employees, I would probably not use LinkedIn because I don't think it's going to be very representative of the type of population. But if you look at startup founders, startup employees, VC investors, LinkedIn will typically be considered a significantly less biased source of data. Lots of these people are very present on these tech platforms, and we do various checks to show that like a lot of the founders, I think more than 92% of the founders in our data actually do have a LinkedIn profile, to give you a sense. And so we are basically able to collect individual level information for almost every company that over the past 15 years has received any type of VC or growth equity funding in Africa. And so a few nice facts will emerge from that. And we do this for all other countries as well as benchmark. And this is what you're going to end up with. That gives you like a picture of overall the data set will be very sort of like global. You still also see that like what I showed you before in terms of growth. Of course, it's also reflecting the fact that Africa is very, very, very tiny compared to the big sort of like ecosystems out there. And that's a fact. That doesn't mean it's not important. It just means that it's a very early stage, and it went from near zero to something that is now growing fast, but it still represents around, I think, like 1.8% of US, let's say, activity in a given year. So keep that in mind as well. And the other piece of data we'll use, which I'll get to at the end, is a survey we do. This is still to some extent ongoing in the sense that we have a few loose ends to sort of like tie up, but it's going to be a survey that we did that aims to cover in as a representative way as we can, also like various countries across Africa. In PitchBook, you will see this as a representation of where the startups are. We're going to have a survey that's going to try to mirror this type of coverage. But a lot of activity in Africa, as you know, it's happening in the big four countries: Nigeria, Kenya, South Africa, Egypt. And in particular, actually, what is interesting is that a lot of it is very, very concentrated in urban hubs. And typically, these urban hubs are very near universities. So like you can think of like Cape Town, Lagos, Cairo, and Nairobi as the big hubs, but they're not just big hubs because they're big hubs in general of economic activity. They are especially concentrated when it comes to startup activity. So just to give you a sense, you have that I think about 33% of the GDP, I think, of Africa sits in these four cities that I mentioned, but about 66% of the startup activity sits in these cities. So like we have a very, very strongly concentrated ecosystem that is right now being built around hubs. And these hubs are growing. Like Kampala is growing, Accra is growing, and so on. But like these four big cities, and certainly the four big countries, are still very much dominating the countries. And if you put this into the activity, and if you put this into more formal regressions, you can see that like being close to universities, to top universities, actually matter quite a bit as to where the activity is. So in Cape Town, you're going to be seeing that being close to UCT, the University of Cape Town, matters quite a bit, and so on and so forth for concentrations in these other contexts. And the survey, as I mentioned, I'm going to skip the details now, but the survey was a big effort by the IFC that relied a lot on disseminating our survey through startup hubs. And so what we did is that we had local partners that us and the IFC have worked with to basically try to say, okay, how do we get responses on a survey from many players based in Lagos, in Nairobi, in many other contexts, including like contexts that are very much underrepresented? Well, the easiest thing is to rely on the local incubators, the local entrepreneurial clubs of universities, the local sort of like investors and venture studios that have lots of contacts with the tech ecosystem. And so we went to them and we asked them to disseminate this survey. And the nice thing is that we received nearly 4,000 responses from the survey. Again, this number might increase with a pretty good response rate for this type of survey that we disseminated around. Okay, let me now move to the facts. So the data now should be clear. PitchBook, local equivalents of PitchBook, LinkedIn, and a survey that we did. Now let's use the data, not the survey, the data we collected to establish an interesting first fact that will guide the rest of the paper, which is the capital will come from abroad. So how do we do this? For those of you, many of you I think are, but those of you who are not familiar with the sort of like VC type of model, you typically have the LPs, the limited partners, often institutional investors or DFIs like the IFC itself, that will provide capital to fund managers, the GPs, the general partners, these fund managers will be the ones, and they can be based anywhere around the world, but they will be the ones that then channel directly the capital to the startups. They will be the one making the decision of where to invest, and so on and so forth. And so we can see both, and we do a lot of work in making sure we can see as many as we can, but the story will not change. If you focus on defining foreign capital as the original source of money, let's say you want to understand where an endowment, like the Harvard endowment, is actually putting the money. The Harvard endowment will be an LP and will be called US money. If you use that as a source of like foreign type of investment, compare, let's say, to a pension fund in Nigeria, the results will be very, very similar than if you use the GPs, meaning the Sequoia of this world will be a GP. They will make investments directly in companies. They are based in the US, and so we will call that a foreign investor to Africa. And so regardless of how you define it, we will use the GP, the fund manager location, to define whether the foreign whether the investor is foreign or not. But it doesn't really matter if you use the original source of capital, as I will show you in a few graphs. And so we're able to basically say, okay, if a company receives money from at least one investor that is foreign, we will say that that is foreign capital, basically. And we can do various sort of robustness to look at whether the majority of the investors are foreign, whether the amount of capital is more than half of the total capital raised by the company, if that is foreign or domestic. We do various of these type of checks, but the story we will see does not change much. And so once you do this, you can plot, in this case, over the time period that we think our data is good, which is from 2010. Before then, I think the coverage gets too spotty. But from 2010 to 2024, what you see is that if you define as foreign to Africa, any capital is coming from investors outside of Africa, and you do the same for all the major sort of like economies, US, Europe, then you have like China, India, and you're going to have like the rest of the world, and you're going to have Latin America and the rest of the world. And then we average these into, you're going to have Africa by itself, and then you're going to have the average of these emerging markets on its own, and the average of the developed markets on its own. What we see is that Africa stands out for the amount of foreign funding. We see that about 80%, relatively stable, sometimes it goes up to more than 90%, but about 80% of the deals in Africa can actually be flagged as deals with foreign investor participation. That is much higher than what we know is a relatively low percentage in developed markets, where it's about 20 to 35%. But it's also much higher than what we see in lots of the emerging markets. And this is not driven just by China having a lot of China capital. You see a very similar pattern in India, LATAM. Of course, some of them will get closer to Africa, but broadly you see a much, much higher presence of foreign capital in Africa compared to any other market. And this presence, even just in absolute terms, is massive. You can think as 80% a number to have in mind as to how big this is. And you can do this also for each given country. To see, like, for, let's say, like Rwanda, what is the share of capital coming from outside? Of course, given that you do it at the country level, the shares will be higher. But what you see is basically you see that Africa, which is in blue, is going to capture the left-hand side of the distribution, which is the one with the highest share of foreign investors and the lower GDP. And overall, what we see is that this is what we're capturing perhaps might be just a sort of like wealth type of like pattern, where the richer the countries, the more they rely on local capital. But the fact remains that a lot of the ecosystem in Africa right now is made up of foreign investors. And we can dig a bit deeper into just explaining a bit more of the facts as to where the capital is coming from. And we see that a lot of the capital is coming from rich economies. US, Europe, DFIs play, of course, a big role also as direct investors, and very little from China, which might be surprising, but it's actually not. If we compare this also to other sources of data from China, we try to really test the robustness of this. And it's true that China does not do almost any direct investment in VC in Africa. A lot of the investments are infrastructure and projects that are funded by government capital that are not about VC, and very, very little from other emerging markets. And you can also look at this splitting by regions in Africa. One thing I want to highlight here is that you also see that a lot of Africa is not very financially integrated from the perspective of VC capital flows. If you see flows going to Eastern Africa from Africa, those will be coming from investors based in East Africa as well. And so you have a lot of like local fund managers investing locally, essentially. That's kind of the story. But in broad terms, most of the capital is coming from US, Europe, and DFIs. You can see here, as what I was saying before, a graph that is a bit more complex in the sense that you have where the capital goes on the right, which regions of Africa the startups are located in. In the middle, it's the GP, the fund manager, that is deploying the capital. And on the left-hand side, the original source of money. Like, where is this coming from? Again, from the Harvard endowment? Is this coming from DFIs like the IFC? And we see here that the story doesn't change. A lot of the original capital is still from rich sort of countries. You have, of course, DFIs playing a big role. We know that a lot of the DFI activity is also as a provider of capital to fund managers, and perhaps they are the ones who actually have done also a bit some more perhaps in trying to provide capital to local fund managers. Okay, these are some of the facts that I want you to have in mind. Now, based on these facts, which I think broadly can be summarized with there is a dominance of foreign capital, let's try to see what the implications might be. I'm going to try to go fast. I'm not going to try to spend much time on the actual regressions. I'm going to try to give the intuition. Okay, so we've shown this reliance on foreign capital. What do we think as potential real effects of relying on foreign capital? Broadly, the story that we want to pitch is if you rely on a specific source of capital, you're likely going to have that source of capital shaping how the startup ecosystem looks like. And we're going to try to explain what we mean. So the first thing we're going to try to think about is that if you do rely so much on foreign capital, it's plausible to think that you are exposed to foreign shocks. And foreign shocks might not be dependent on what's happening, let's say, in Nigeria fintech, but they might be dependent on what's happening to global interest rates. And if that's affecting a lot of the global investor activity, and you rely a lot on global investors, then you're going to be subject to these fluctuations, while a more sort of like self-reliant ecosystem might not be exposed to shocks that have nothing to do with what's happening locally. And so how do we do this? For those of you, of course, like the standard shift share approach, this is going to be a bucket design where we're going to try to think about exposure of each given sector and country to foreign investors. So, for example, we're going to try to compute the share of Nigeria fintech startups that in the pre-period, in the 15 years from 2000 to 2014, let's say, so that we fix that time period, we're going to try to compare the share of activity in that sector, in that startup sector, country pair, and we're going to try to look at how exposed it is to foreign investors. So what we're going to be able to say is, let's look at country sector pairs that are going to be particularly exposed to foreign investors. And then we can construct a shock that tells us how much that given sector country pair is going to be affected by global fluctuations. Example, you're going to have that Nigeria fintech relies a lot, for example, on investments from the UK. Then what we're going to see is that if there is a global retrenchment or a global push from UK activity in fintech, meaning, let's say, BII decides to cut fintech funding by half, hypothetically, of course, then that specific cell in Nigeria fintech is going to be particularly exposed to that type of shock. And so that we construct all these type of like exposure measures across all these country sector pairs, and we take the average across them, and we see how this movement on the supply of capital globally that has nothing to do plausibly with the local sort of like exposure measure, how this is going to affect activity in those specific cells. So long story short, again, I will skip the regression parts for the sake of simplicity. But what we see is that perhaps unsurprisingly, these shocks to global supply of capital that is specific to specific sectors and regions will have a strong effect in predicting where the deals will happen and how big these deals will be. In practice, what this means is that capital is essentially frictional, and so it's hard to substitute for. Meaning, if Nigeria fintech relies a lot on UK funding, if you cut UK funding, it's not going to be easy for startups doing fintech in Nigeria to simply substitute away and get capital from, let's say, other local investors or perhaps US investors and the like. And so this is an important point that I think we established to say the foreign supply of capital will determine a lot of the activity locally in Africa, because Africa depends so much on foreign investors. And you can do lots of robustness, which I'll skip. But these results, it's quite strong. Let me skip this too. Let's now move on to a second implication of what we see, which is if you rely a lot on foreign investors, it's plausible to think that you're going to also end up with a lot of foreign human capital. And I'll explain what I mean. But so in particular, what we think is that if you rely on foreign investors, then there might be frictions that we need to be aware of as to who is able to attract investors that are foreign. And in particular, of course, we know that many things from proximity to even potential sources of discrimination might matter in the sense that foreigners or people with foreign experience might have more exposure, might have easier access to foreign funders. And so we want to understand whether having so many foreign investors means that you're going to end up with a lot of foreign human capital. And then we're going to see that that is indeed the case. One way to look at this is just to look at the simple data, simple summary stats. So that's a table that I think to me is quite striking. We're looking now at now we're bringing in the LinkedIn data. So we're able now to tell you more about the characteristics of the founders. And then in the next table, I will show you also the employees. But what we see is that basically a big chunk, about half of the founders in Africa are either educated abroad, meaning they have at least one stint of of secondary education and tertiary education in outside of Africa, or they have experience abroad, maybe a job that they did somewhere outside of Africa. And that's significantly higher than what you see on the bottom rows in Europe and North America, where the percentage is more about 20 to 30%, and also significantly higher than what we see in other emerging markets, like Latin America and India. China is not here because LinkedIn is not going to be good for covering China. The startups, we're doing separate work on that margin that we can discuss separately, but it's going to have the same story. And so Africa startups are very much founded by people that look either like foreign founders or they might be foreign themselves. That's a different story. But what we have as another piece of evidence that telling us how strong this pattern is that we did a lot of work. So in LinkedIn, you can see the pictures of the founders. You can see the pictures of the employees. And so we look at these photos and we manually classify all of them also by race. And we see also we try to do as much as we can to try to characterize who might actually be foreign. And one crude dummy for several contexts, of course, several countries in Africa, that we can see just a percentage of people who are white. And while this is going to be, of course, obviously an imperfect proxy for who's from Africa or not, it just does look striking if you just compare to the population censuses, that about 44% on average. So nearly half of the founders in Africa are actually white. And so we did a lot to make sure that we capture this in a very conservative manner. But the story here remains that it looks like a lot of the founders across Africa are going to be foreign or perhaps exposed to foreign type of education or experience opportunities. And that's something, again, it's a fact, it's just the data. There is nothing else other than the data. We can do more in terms of looking also at employees. Employees are going to paint a similar picture. If anything, it gets even more interesting. We see that the percentage of employees who are white is 40%, still very, very high. The percentage of them who are educated or experienced abroad is a bit lower than the founders, but still pretty high. And the comparison changes a lot. In most other emerging markets, perhaps you might have a few foreign founders, but employees are typically local. In rich economies, you might have less foreign founders, but a lot of foreign employees. In Africa, you have both foreign founders and foreign employees. And so that's a striking pattern painting a picture of African startups that is very foreign itself. Again, we're not making a statement whether that's good or bad. It's just the fact is we see foreign investors. This looks to be reflected also in the fact that many of these are foreign founders. And of course, I'm implying here that there is a channel from the supply shocks, meaning there is more foreign investors, therefore there is more foreign founders. That's something we can do with regressions like in Bartik, which now I'm going to skip for the sake of simplicity. But so far, we've seen that you are exposed to foreign shocks. You tend to have foreign human capital. The last piece of evidence I want to show you is that there seems to be also potentially evidence that these companies are also doing products that are foreign themselves. What do I mean? What we do is that we look at the text descriptions from PitchBook, LinkedIn, and other sources of the products that these companies do, meaning they describe what they do. They have a paragraph or two paragraphs describing that they are let's say, a platform that allows for borderless transaction across countries and so on and so forth. And they give as much detail as they can. It's not going to be perfect. But we looked at these text descriptions of all the startups across Africa and across other markets. And then we try to look at whether these descriptions are going to look like descriptions of startups that are from other African contexts or from contexts that are outside of Africa, let's say the US. And what we see, again, now I'm going to say it in words for the sake of brevity, but what we see is that a lot of these startups in Africa are going to look more like startups. These are examples, by the way, of this type of like descriptions, are going to look more like startups that are coming from the location where the investor is, or where the founder studied abroad, or where the founder has experience abroad. So in practice, this means that there is textual similarity of business models and products that suggests that the companies that have a foreign investor are going to look a lot more like companies that are based outside of Africa rather than local companies. Now, is this good or is this bad? We're not able to say that. There is some interesting evidence on paper, for example, by George Lerner and co-authors that show that this could be interpreted to some extent as misallocation of innovation. Like if you're producing potentially products that are looking more like the US markets, that might not be what actually is relevant locally. But again, this is just speculation. We don't know. It is a fact, though, that the type of investor determines the type of products and business models that these companies do, which is something, again, to keep in mind. And so this is the summary of these three implications. Then, Raul, I know I will have I'm running a bit late, but I'll make sure to close at 50 rather than 45, if that's okay. But let me summarize the three implications we have of this foreign reliance. One is that if you rely a lot on foreign capital, you're going to be a lot more exposed to foreign shocks. And we identify this in the data. You're going to potentially rely a lot more on foreign human capital. And we identify this in the data in a very strong manner. And you might facilitate the adoption of mostly foreign products and business models. And so you're going to basically end up with an ecosystem that, because it relies so much on foreign investor, it also has a few aspects that are very different from other contexts out there, and that we might want to keep in mind when we think about policy, when we think about policy for development of this ecosystem. Because, again, we don't have anything to say if this is all good or bad for the overall economy, but these are important implications to keep in mind if you want to build an ecosystem that is robust, not fragile to outside shocks, and that perhaps has a lot of the components that have to do with wealth creation, but wealth creation perhaps remains local rather than being primarily going outside because of the investor base itself. Let me spend the last 5 minutes to talk about something about the drivers. So we established a fact. I told you about some implications. Now let's take a step back and think about why this capital might be coming from abroad. And here I want you to think about one part of the discussion. I think it's relevant for policy, which is on the one end, when it comes to like what drives this, we may think that this is about the type of capital that is just not available domestically, or the type of investor that is not available domestically. And of course, you can imagine that's strong implications if we think about how to develop this type of like financial infrastructure. Do we want to train fund managers? Do we want to change the way the local financial system operates? And so what we do is that we do a study, a survey, in sort of conjunction with our partners at the IFC, where we try to survey many startups that did not reach the success status we saw before, meaning startups who actually receive capital, but they are looking to raise that sort of capital. So we think that surveying companies and understanding their constraints and their demand for capital investor types at that stage is what matters for policy, because those are the companies that are going to be precisely end up looking potentially like the ones we saw that shape an ecosystem that is very much a foreign ecosystem. And so I'm going to skip the details, but as I mentioned, we try to be representative. We're going to do a few more steps to make sure we are representative in terms of the survey across all of Africa, but it's a survey that covers nearly 4,000 companies across almost every country in Africa, with a lot of them coming from Nigeria, Kenya, South Africa, as you would expect. But also covering many other of the smaller economies and smaller VC ecosystem. Let me skip also like characteristics of the founders. We have lots of data, if you're interested as well, that we collected through the surveys about who these companies are. But it's mostly just to say these are young founders, young companies. They are mostly college educated, which is the same as what you see in the main sample. And typically these are financially constrained. This is just a graph that tells you like lots of these people are looking for about $500,000 to $1 million. They typically say that we're only able to raise about 25% of them. That's one way for us to think about them being financially constrained, but that's not surprising. Many of them rely on personal savings, family and friends type of capital, and they think that access to capital is the biggest challenge they have. Again, maybe not surprising if you have a survey coming from the IFC that you say that you want money, but it is the typical sort of like response you get from this type of surveys, which suggests that indeed this is an important constraint for them. So the way we did the survey was to have this sort of like connecting Africa's entrepreneurs study. It's still ongoing because we are still sort of like making sure we can provide the startups that responded with some interesting data points and potentially some sort of like support. The goal was to make sure that we can replicate a system in which startups are actually thinking about evaluating potential investors and forms of capital in an incentive-compatible manner. This is not a full academic talk, so I'll skip the details, but this is an empirical design that I think allow us to get a lot more beyond what you typically have by just asking people. If you ask people, you're not going to get precise answers. You're not going to be able to compare sort of like a foreign investor from a big investor because they tend to be both. And so we design an experiment and a study that allow us to get around that. I can refer to some of the prior work in China and some of the prior work in the labor literature for this. For now, we can go straight to the result. And so what we do is, in practice, we ask many startups to evaluate, in terms of like their interests, various different profiles of potential investors. This is just two examples. These are all hypothetical investors. We mask and anonymize like names in terms of making them fully fictitious. We are able to provide them with a list of potential investors that are going to look very different. Some of them are going to be foreign. Some of them are going to be local. Some of them are going to offer equity. Some of them are going to offer debt. The amount of capital is going to be randomized. So the point is, we have them play a game in which they're choosing who they like, and who they like is a mix of components of the investor, of the capital, that will allow us to estimate the preferences of what they really care about. Do people respond very positively to a foreign investor, suggesting that perhaps what they want is a foreign investor that might help with networks, might help with support, and so on and so forth? Or do they respond more to they want cash and they want it through equity, through debt? Or do they respond more to the prior success of the investor and the like? All of these things are things we don't know, right? You can ask people, they will tell you lots of things. We design a system to evaluate what they really care about. And so in practice, the results of this type of like experimental setup and regression are that startups really do not care about the source of capital. That would be the blue points you see. What I mean is that startups do not really have a preference for foreign investors. If anything, they want investors with local knowledge, local roots, with a local team. That's what they're looking for. Ultimately, though, these are all minor. They don't really care much about also like what other sources of non-financial support you provide. What they want is the capital, and in particular, they display a very, very strong preference for equity financing. All else equal, meaning I'm going to be able to give you $500,000, and we can vary the interest rate or we can vary the equity stake you want, but you're going to have such a strong preference for equity that trumps everything else, which to us will suggest that startups in Africa are really missing local equity financing. That's what they want. Then equity will look like it's only available by foreign investor, and that's what you're going to end up with. But in practice, in startups of this type that we surveyed, and it's a lot of them, it's almost 4,000 across all of Africa, they display above and beyond a preference for equity financing, more so than many, many other things. There is lots of other interesting results here that I'm not going to be able to speak to, but I'm happy to engage more in the Q&A shortly. Lots more analysis we do here to test the robustness of the results. To conclude, this is the equity financing ecosystem around the world. Almost no investor in venture capital in terms of size will be located in Africa. That's just a fact. Most of them are going to be based in log scale. So you have a massive dominance of US and rich economies. And so if that's the ecosystem you're looking for, and firms are looking for the type of capital that only foreign investors are providing, then of course you're going to end up with an ecosystem that is very much dominated by foreign investors. That's indeed what we find out. That's a story we try to tell. And the few insights we want to highlight is that this reliance on foreign capital will have a lot of implications we need to be aware of. And if you want to develop sort of like a market that is more conducive to the demands of the local startups, then we want to think about developing what right now is a missing local equity financing market that is growing, but it's still very tiny and potentially needs to grow even further. I'll stop here. Thanks, Raul, for being kind to me.
Um, No, thank you, Emmanuel, for this great presentation. It really brought out like how much Africa's startup scene is shaped by like foreign capital, not just in terms of funding, but also like who gets to build, run, and benefit from these companies. The points you raised, the points you raised about the like it gives us a lot to think about like future of entrepreneurship in the African market. We can already see a lot of questions popping up, but before that I have a question. So you mentioned that founders with international education or foreign backgrounds are more likely to get funding from the foreign investors itself. So and you also talked about misallocation of innovation. Do you think this kind of funding pushes startups to build things that appeal more to the Western investors, even if those ideas are not best for the local needs?
I mean, I obviously what I think does not matter, meaning like ultimately what I can say with the data is what you stated, which is it's a fact that these products they are creating are looking like that. We don't have evidence to say as to whether the incentives are changing in such a way that, yes, if I want to create a company and I want to raise $5 million, I better create a company that the VCs in the Silicon Valley will like, because that's what I want. And then maybe that might not be what the local customers want. This is a plausible story. I don't have evidence to say it, but for sure, if it's plausible, and we have data that suggests that this could be the case, we better understand if that's the case. And so that's an open question, I guess. I don't know if that's the case, but certainly it's something we should be thinking about.
Amazing. Thank you very much. I'll go to the Q&A and I can see. So
I'm happy if you want, Raul, I'm happy to have a look at the questions and try to like go quickly over them if that's easier.
sure. Yeah.
But so I'm gonna go through more or less as it goes in the list. So who are the key players in the Africa VC startup ecosystem? That's a very broad question. I think hopefully like it's clear that a lot of them are gonna be foreign investors. I think if you're asking about who the specific investors are and so on, we can maybe discuss offline just because it's a more descriptive questions and I don't have the data point right now with me, but there are many type of like ways to answer the type of question. A paper will be available soon. We're making it public once we wrap up the survey and the study with the IFC. We think that should be early in the summer. So like June, July is so soon, I guess. Great question on the how do you explain the low rate of business startups in French-speaking African countries? So that's an anecdote as well that people are often referring to. Of course, I'm not going to have, again, a clear, conclusive answer because I think it's a tough answer to answer empirically in a conclusive manner. Part of what we see is that a lot of the funding flows can be predicted by things such as sharing the same language with foreign investors or having like other type of linkages to these foreign investors. And you can expect that, of course, French-speaking contexts are going to have potentially connections with French-speaking countries outside of Africa, but there is a lot more English-speaking countries outside of Africa, and there is a lot more capital coming from English-speaking countries, primarily the US and the UK. And so part of the reason and part of what we're trying to shed light on is, yes, if you rely on foreign capital and foreign investors, then how connected you are to this context matters a lot. And that probably does not have anything to do with how good the investment opportunities locally are, which essentially suggests that there are frictions, and it's a bad frictions because you can end up potentially with French-speaking countries not having access to capital for reasons that have nothing to do with the local quality of the talent and the startups. And so that could potentially be a friction that is costly. It's a problem, and I think practitioners have been thinking about this for quite some time. Rania, good to see you. We should catch up. You're asking like how different are the socioeconomic indicators of the employees when the capital is low? Yes. So I haven't shown this. We do this both in regressions and in summary stats, but in practice, the answer to what Rania is asking is that we do see that startups that rely more on foreign investors tend to be the ones with foreign founders and with more foreign employees. I don't have an answer if you're asking purely about whether foreign investors tend to invest more in founders that are female, white, highly educated, and so on. We can provide that precise answer. I'm not going to be able to give, I don't want to risk giving a wrong answer right now. But there are strong differences. So I'm sure there are some differences across many socioeconomic indicators that matter. And then Ibrahim is asking about industries. Yes, I didn't show the industry distribution. The nice thing there is that you do see a distribution that is very much different than what you see in the US. So you have a strong role played by fintech that has dominated a lot of where the funding came. Some people like complain about that type of aspect, but a lot of money went to fintech, even more so than what the type of money that goes to other contexts outside of Africa. Lots of money went to energy type of and climate type of startups. And agri-tech, as you might expect, is significantly present in Africa. It's not the case for many contexts outside of it. So these are just some facts. I have probably still 2 minutes, so I keep going, Raul, if you don't stop me. One more question is information on the many startups that are successful. Okay, I guess that's a question of what can you say about returns, about success of these companies? That's a tough question. I didn't show anything here, but we are doing work on trying to speak more to success. It's very hard to define success in this context. This is a long-term game, as you know, where lots of these companies are trying to achieve an exit late, after 5, 10 more years even. And so we don't yet have so much time to be able to evaluate success of the VC ecosystem in Africa if we just look at those who got money in the last 10, 15 years. The little we do have is information on who's able to fundraise in multiple stages, who's able to get more employees and so on. And so preliminary evidence there suggests that those who are able to attract foreign investments are also able to keep attracting more funding, to have more employees and so on. I don't know if that's a good or a bad thing, and it could just be a sign of the same symptoms originally, that those who are able to fundraise from foreign investors are always able to do so. But the long story short is that we have data on exits, like IPOs, acquisitions. Mostly it's acquisitions that people exit through. We haven't yet put this into the paper, but we will. On Michael questions, I'll defer it to later in terms of yes, there is a lot of variation within Africa on the patterns. And I think you can do something with the development of the local financial ecosystem. Usually those with a more developed local financial ecosystem tend to have more local investors, which is also potentially good. We don't have much difference in terms of what they're looking for. We still see that from the survey across almost all of the countries we focus on, we see this massive preference for equity type of financing and a strong disregard for type of investor. Is this foreign? Is this not? Is this offering mentoring and other type of support or not? And finally, on the exporting margin, we do not observe that. So I'm actually right now not able to say much on that. But that's actually a very good question, Andy, and we could think more because we can see where the employees are. That's one way to think about whether they operate outside. We can think about how they describe the business. And in the survey, we asked some questions as to what their market is. I think I covered all the questions, Raul, in the chat. I'm afraid we don't have too much time for questions from the audience, but I'd be happy to collect messages via email if you would like.
No, I think you're right, and we are out of time. Thank again, Emanuele, for taking the time to share your research today, and thank you to the audience for joining us. I just wanted to inform that the next IGC PSDRN seminar will be taking place on June 13th, led by Dr. Florian Munch, and he'll be sharing his insights from an RCT on female-led businesses in Tunisia, exploring how export consortia impacted firm performance, exports, and entrepreneurial empowerment. So you can find all of these details on PSDRN and IGC websites. My colleague has also shared about it in the chat. So please take a look. And thanks very much. Thanks, Emanuele.
Thanks again, Raul, IGC, IFC, and everyone else who supported this. It's been a pleasure. See you guys soon.
Thank you.